When it comes to day trading, Bernard Baruch says, in day trading or investing, it's not about how much money you make, but rather how much money you don't lose. Are you a day trader who's looking for some ways to reduce capital gains tax? Then you're in the right place. Welcome to our comprehensive guide for day traders. Investing in stocks and bonds is a great way to build wealth. However, you need to pay tax on the profit that you make through the sale of each commodity. So it's crucial to understand how taxes on stocks can affect your tax bill, especially if you are involved in day trading. As a reminder, I'd like to see you invest in the channel by clicking the like button and helping us reach our goal of 50 likes. Subscribe later. Day trading is when investors buy and sell shares in a company or a commodity within a single day. It's a profitable activity for experienced and skilled investors. But at the same time, this frequent trading triggers tax and accounting headaches for investors. So in this video, we'll discuss what capital gains tax is and how you can avoid paying the capital gains tax during the day trading. I'd also like to remind you that I am not a tax professional and none of this should be considered tax advice. What are capital gains taxes? If you have shares of stock in your brokerage account, then you need to pay tax when you sell those shares at a profit. There are two types of capital gains taxes we're going to talk about: short-term capital gains tax and long-term capital gains tax. Short-term capital gains tax. Short-term capital gains tax is a tax that you need to pay on profits on the sale of an asset that you've held for 1 year or less. The tax rates for short-term capital gains are the same as your usual tax bracket. When you day trade, you need to pay short-term capital gains tax. There are plenty of videos on YouTube that can help you figure out what tax bracket you're in. Let me know in the comments if you'd like me to make a video discussing that matter. Long-term capital gains tax. You need to pay this tax on the profits you made from the sale of assets that you held for more than a year. You're taxable at either 0%, 15%, or 20%. Furthermore, the taxable amount mainly depends on your taxable income and filing status. Usually, the long-term capital gains tax rates are lower than the short-term capital gains tax. This means you can save money by holding the shares or a commodity for more than a year. However, as a day trader, you don't get any benefit from long-term capital gains tax. So you should focus only on minimizing the short-term capital gains tax. When you need to pay capital gains taxes. You only need to pay capital gains tax when you sell your investment at a profit. Furthermore, if the value of your shares is only rising on paper, then you do not need to pay the tax until you sell your share. Capital gains taxes are applied to most investments except jewelry, antiques, art, or other collectibles. Also, the income from a business is not taxed at capital gains tax rate if you are actively involved in the company. How to minimize capital gains tax when day trading. There are 3 strategies that you can follow to reduce your capital gains tax. Number 1, market-to-market accounting. If you're categorized as a day trader by the IRS, you can benefit from market-to-market accounting, which is a tax filing selection. For this, you need to report all of your annual gains and losses about everything you sold to the last day of the year. By doing this, your net losses can be accounted for against your income on an unlimited basis. You're not limited to $3,000 like known taxpayers who pay taxes on ordinary income. The money you make from day trading will always fall into short-term capital gains tax rate instead of long-term capital gains. Moreover, the percentage of these tax rates change after every few years depending on the political landscape. But it's for sure that long-term capital gains tax will always have a lower tax rate than short-term capital gains. Number 2, tax loss harvesting. In this strategy, we make use of wash sales. If you don't know what the wash sale definition is, don't worry, we'll explain it to you. A wash sale is defined as a practice of selling a stock at a loss and then repurchasing the same stock within a short time frame. This short time frame is defined by the IRS as 30 days. This specifies that the repurchased security does not need to be identical, but substantially similar. Moreover, this rule also applies to the business partner or spouse repurchasing the security. The wash sale rule for day trading mainly prevents retail investors from selling a security for a loss and then repurchasing the security shortly into the new year. However, this rule does not apply to those who are categorized as day traders by the IRS. Now you might be wondering why anyone would sell their stock at a lower price. It's because they want that loss to lower their adjusted gross income. Furthermore, they repurchase the security later on. This strategy is mainly followed by people who are not concerned about the temporary impact against their long-term capital gains. However, if an average investor who is not classified as a day trader uses wash sales to lower their income tax, then it will be considered as an illegal activity. It's probably wise to only use the wash rule of day trading only if you're classified as a day trader with the IRS. And number 3, get the benefits of not being subject to self-employment tax. The profits from trading are not subject to the self-employment tax, unlike other Schedule C taxpayers. Self-employment tax is basically a tax that consists of Social Security tax and Medicare tax for people who work for themselves. But a day trader doesn't need to pay this tax, which is a good thing. However, there is an issue some may consider to be a downside. Since you don't make contributions towards Social Security, you will not qualify for Social Security retirement or Social Security disability insurance. But as most day traders are financially savvy, they should know how to invest their money for their retirement goals. It's unlikely that day traders will need a Social Security system that might not even exist when their retirement age comes around. Tax deductions for day traders. When it comes to filing your taxes, you can consider the following expenses to reduce your tax as a day trader. Office expenses. Home office. As a full-time trader, you have the option to work from home. When you're self-employed and use your home as an office, then you get to claim deductions on your tax. You can claim deductions on a portion of your mortgage, rent, or other utilities of your workspace. Outside the office. If you do day trading from an office outside of your home, you can claim deductions on your rent, utilities, and other costs. Furthermore, you can even deduct travel and vehicle expenses. Whether you work from home or an office, you need the necessary things to keep your office functioning. You can claim deductions on equipment and supplies up to a certain value. You can claim deductions on furniture, computers, software, internet service bills, and standard office supplies like pens and paper. These are just some of the things. You can take deductions on everything that you use for your work. Depreciation expenses. When things get old, their value decreases. So as a day trader, you can write off this depreciation on your taxes. Equipment like furniture, software, and other business supplies above the tangible property threshold qualify to claim depreciation expenses. Moreover, both new and used property is eligible to be claimed. However, you can only claim depreciation value if your income offsets the deduction. Trading resource expenses. Education. As a day trader, you need to keep yourself updated with the latest information and strategies in the industry, which may cost you money. You can claim tax deductions on education costs like seminars, classes, books, and guides. Professional counsel. If you've ever consulted with an expert for investment advice or to improve your strategy, you can list those fees while filing your taxes and get a deduction on it. Other business fees. Even if you don't spend any money on consultants, then you can claim tax deductions on service fees related to your investment in trading. This can include legal, bookkeeping, accounting, and other business operating expenditures. Interest expenditures. Although you don't borrow a massive amount of money, there are chances you may still take a small loan to purchase your positions. Any interest that you pay on these loans can be deducted from your full income during tax season. This is known as margin interest. Moreover, your paid credit card interest related to your trading endeavors can also qualify for a tax deduction. I hope this video helps you in reducing your income tax while day trading. If you found this article worth watching, don't forget to share it on social media. If you're a YouTuber or are considering starting a YouTube channel and you like my editing style, click the link in the description to get a free trial of my software. Check out these videos on your screen on how to improve your finances. If you like this video, hit the like button. It helps out a lot. Be sure to subscribe and share the video with your friends. Check the links in the description for offer information. Thanks for watching, and I'll see you in the next video.